In the news, okay, here's something else I want to talk about in the news, okay? The stock market is up right now, guys, okay? So what should you be doing? And it's looking good, okay? Stock market's looking great. I'm making a lot of money. Hopefully you are too. With my portfolio, which I share with you guys also. But overall, when the stock market is up, am I happy? I'm indifferent. I really don't care. Because as a long-term investor, you're investing consistently over a long period of time. You don't really care about deviations that happen, for example, over a short period of time, because it just happens, right? You have ups, downs, whatever. Now, the one thing is, guys, that basically we have not seen, most of us watching this live right now have not seen a real depression, right? A real stock market crash. You know, a recession is when your friend loses his job. A depression is when you lose your job. That's what the saying goes. You know, it's pretty funny. But overall, there was a stock market crash that lasted around 25 years until the market actually recovered. So when I think about a market crash, like, will the market crash? You know, I think about, will the market be down for the next 20 to 25 years? I think about that. And that's something to worry about. So the idea is, what do I do to make sure I don't gotta care about this? What I do is, first of all, I do three things here. The first thing is I do dollar cost average. Meaning, for example, I invest the same amount of money in a very frequent manner. Meaning, for example, I invest into my portfolio 10% of my income every single month. That's dollar cost average. Why is this important? Because the stock market is not just going to crash, for example, out of nowhere. It'll be, for example, usually kind of like this. Sometimes you have this and then this, but it just won't be, for example, like whoop, right? Probably won't happen like that. So if you're buying every single month, that means you're going to buy at the end of the year for the average price for that year. Meaning, if the market is down, you'll buy for a discount at the end of the year. If it's up, you'll buy for a higher price. But you want to continue to buy when it's high and low. That way you don't miss out. And that way you're not just in when it's too high. You don't want to do that. Because if you bought all the way high, now it's down, now you got to wait forever to have that recovery. No, just keep investing the same amount over a period of time, right? Very frequently. Second thing is, I rebalance my portfolio. Meaning, I love this about M1 Finance. They have dynamic rebalancing, and they also have, for example, standard rebalancing. Rebalancing is basically when you sell some of your investments to buy the other investments that are basically underweight. Meaning, if I want to have 50% stocks, 50% bonds, but stocks are up this year, so now I'm only like 60% stocks and then 40% bonds. I want to sell 10% of my stocks and then basically buy 10% worth of bonds. This is good because it means, for example, I'm always selling when the market is high and I'm always buying when the other part is basically low. It's kind of like a very intuitive way to kind of predict the market, but you want to rebalance. But the good thing is basically if you do dollar cost average with M1 Finance, you will automatically rebalance because they'll buy exactly what they need to buy. So that balance never becomes that crazy. So that's also something you want to look towards to. However, if you do find yourself with this very strange balance of, hey, this is not what I want, you want to usually rebalance every 18 months to make sure you don't get like some crazy taxes and so on. So every 18 months is when basically you want to basically go ahead and rebalance. The third thing I do is I buy the dip. So if I find out that I'm investing 10-20% of my income, but I actually have extra income, the answer is I can grab that extra income and basically buy the market when it's crashing. So I buy it at a discount. But remember, when I say the market is crashing, guys, you got to have courage. Courage. Why? Because it's not just going to crash, for example, for 3 months or 1 month. It might crash for 10, 20, 30 years. That's massive. Will it happen? I don't know. But it has happened in the past, and I can tell you that. So you got to be prepared for everything. That's why I'm saying you don't want to put all your eggs in one basket. That's why I want to have a paid for house. I want to have my investments. I want to have rental income. I want to have my business. You want to be diversified. You want to have passive income. You put all your eggs in one basket, that's never the smartest thing ever to do, okay? That's the first thing. But that's the news right there when it comes to the stock market and what's going on right now. It's up right now, but as long as you follow the rules, it doesn't matter. Just keep buying. There's no need to predict the market or anything like that.